Welcome again. This is Robert Schein, Managing Director, Partner, Blanke, Schein Wealth Management. Today is Tuesday, August 30th, where as we close out August, we're now trending lower on the S&P 500. We're going to talk about oil today. We're going to talk about the markets. We're also going to talk about, obviously, interest rates in the Federal Reserve. But more importantly, let's go to where the indices are right now, measured by the S&P 500. We pay a lot of attention to the S&P from a technical perspective. There's a lot of technical analysis that our investment committee does, that Wall Street does, as a matter of fact. And you want to make certain that the markets are behaving as they should, maybe within bandwidths of expectations. And there are a lot of underpinnings that traders again, we're not traders, we're long-term investors, but structurally, when we put capital to work as we invest for our clients, and again, we have money on the sidelines ready to put to work at high quality, high conviction names that we have on our shopping list. We wait for markets to come to us and then we go shopping, but there's a discipline that we apply. And in that discipline, we wait for markets to hit some structural or technical, let's say, declines. And right now, we're in that sort of camp today, today's trading day. That's why I'm bringing it up for the S&P 500. Now, going back to 8/16, we had the 200-day moving average for the S&P 500, which is just over 4,300, 4,301 to be exact at that time. And that's when the market itself hit that mark. And ever since then, that's the top bandwidth of the 200-day moving average. So it was a ceiling for the S&P 500. It started trending and trading lower until we get to the bottom of the technical analysis bandwidth that we follow is the 50-day moving average. So you have markets from sometimes when you have no news or you're waiting for news, like next month, we just had the Federal Reserve with Jackson Hole last week. We had a sell-off because we knew their expectations. As my grandfather says, less talk, more work. And anecdotally, it's interesting to note that was the shortest Jackson Hole speech from a Federal Reserve chairman in over a decade. In fact, it was by 50% shorter than any other speech. And my grandfather would say, less talk and more work. So obviously, it's not about the talking anymore from the Federal Reserve. It's about what they're going to do. He came out, Federal Reserve Chairman Jerome Powell was very, very hawkish. Everyone expected him to be dovish because the month before he was. And he just came out and he basically channeled the inner Paul Volcker from the early 80s, the Federal Reserve Chairman that's credited with breaking the back of inflation back then. And then we had a multi-decade expansion once we got ahead of inflation, but we're in the middle of it. We're in the midst of it. And the chairman of the Federal Reserve has to talk dovish, or hawkish, not dovish. Now, how do we know that's to be the case? Well, the tens don't lie. The twos and the tens as we're talking about it. And that's the 10-year treasury note, or the 2-year, if you will. And right now, the 2-year, the interest rate on the 2-year is at a high we haven't seen in quite some time. And we could see the 10 years retest earlier. What we saw earlier this year is the 346. Why do I bring that up? Why does it matter? Well, keep in mind, when interest rates rise, right, some long-dated asset classes like technology or other sectors of the S&P 500 decline, number one, in terms of just the pricing, the price to earnings ratio. It weighs longer on their earnings, if you will. But that's why I invest in growth and value. We have companies that are in the value camp that are going to do well in rising interest rate environments, like financials and so on and so forth. That being said, it's not uncommon to see, since interest rates are rising, the 10-year treasury and the 2-year didn't buy what the Fed was selling last month, which was the dovishness. They're being hawkish, meaning they're going to raise interest rates. They're going to keep going. We expect in September 75 basis points. In the meantime, before now and then, there's a lot of data. There's a lot of time. So what happens is the 10-year treasury is going to probably retest, again, from a technical perspective, the top end, the high for this year. Do we break through it? Probably not. When do we position? How do we position? We're going to see us getting closer. Markets could be selling off as a result, and we'll be putting capital work in the bond market. This could be the best as we get closer to the over 3.4% yield on the 10-year treasury. That could be a great opportunity to pounce on some fixed income. We're waiting for that. We had a great strategy call with some fixed income institutional money managers this morning. And again, they just reiterated our thesis and confirmed what we're thinking here at Blanke Schein Wealth Management. That being said, oil is down today for just today. Sell-off is there, but the longer-term trend for oil is intact. In fact, this fall, going into winter, especially globally, it's a global story. We could be energy independent if we want to. Our policies here choose not to. but then that impacts the world. Now, oil, Russia is unfortunately making more money now than they did. It's been reported that they are actually making more money now than they did from all the sanctions as a result of the war in Ukraine, which is shameful. So there's really something in the energy market that's going to break on a global scale. We're all interconnected and interdependent. So even though we think we can, let's say, not buy from this party over here and buy from that party, well, that party goes to buy to this party from that party, and essentially around the globe, unfortunately, we're probably buying from the one person we didn't want to buy at the very beginning. The long and the short of it is that there is going to be a lot of resource pressure, resource demands, right? Because the supply has been shut off, right? Here, US and globally. So even though today there's a sell-off in energy, in oil, longer term structurally, we like this trade going into the fall. So we're going to be looking at that as an opportunity. In the meantime, when do we buy? Well, right now the S&P 500 is below the 50-day. Okay, so if we close below it, that means that structurally we could be going lower, and we'll see how it goes. But if we close above it, there's a good probability we stay in the bandwidth from the 200 to the 50-day moving average, let's say for the S&P 500. And if that's the case, even as we get closer to the 346 on the 10-year Treasury, that is a great indication and a great setup going forward. We like it as long as there's not more structural sort of decline on the downside of the 50-day moving average, more damage technically speaking. So that's what we're paying attention to. So hopefully it's sort of the noise behind the market itself. When markets sell off, there's a reason, but there's also things inside technically and fundamentally that we're paying attention to. Again, earnings are on the forefront. We always pay attention to what corporations are saying between now and the next earnings report. But in the meantime, they're chugging along and they're making profits sort of month over month and day over day. So that's what we'll keep an eye on. Thanks for watching. Until again, next time.